Welcome back, folks, to Investor Diaries. We were away for a while as we had a lot going on in our personal lives. And to ensure that we do enough justice to our viewers by bringing on quality content, we just decided to take a pause for a little bit. But now we are back and we are excited to bring you some quality research and content.
That's right, Abhi. So let's dive into this video. Now, while we were away in the past 3 months, the stock market scenario has completely changed. And look how it's gone. The market has been extremely volatile, and most of the stocks today seem to be in an oversold category. A lot of our recommended stocks have taken a huge hit. In this video, we'll speak about what's going on in the market and what should you, as disciplined investors, should be doing in the current scenario. And just to give you a brief snapshot, in 2022, year to date, Dow is down by 20%, S&P is down by approximately 25%, and NASDAQ is down by approximately 35%.
In the meantime, inflation rates have gone up, but wait a second, interest rates are high as well.
So let's unpack that. What's really happening in the market? How does interest rate become a factor in the middle of all of this? And how is inflation linked to the markets? Will we have a recession coming in? And if we do, what should you as disciplined investors be doing? Should you take all your holdings out of the market? Or should you stay put? Or should you go all in? Let's find out in today's video.
Before we go into stocks, we think that it's worthwhile to understand what's happening in the market right now. Right off the bat, things have become extremely expensive.
Prices have gone up much higher than it was last year. My grocery bills have ballooned, furniture has become expensive, and rents have gone up quite a bit too. And gas prices, which also contributes to all the other prices, have also not been left behind.
Absolutely right, Nitish. So you spoke about goods, but I'll say that it's not only goods, it's also services as well. So on one side, we see that goods have increased in pricing, and on the other side, services sector has also seen a huge inflation.
That's right. These are all contributing factors to high inflation. The rise in prices across the board was caused by many different factors. The war in Ukraine led to a spike in energy prices, while the supply chain shortages affected by the price of other goods. In other words, high prices are caused by having too little of supply of goods and services, while at the same time having too much of demand for all of these goods and services.
So that's where the central banks or the Federal Reserve System comes in. Its primary function is actually to maintain a low inflation rate and low unemployment rate in the country, which it kind of does by controlling interest rates. By increasing the interest rates, the central bank makes it more expensive for banks and subsequently for consumers and businesses to borrow money.
For consumers, higher interest rates would mean it's more expensive to buy big ticket items that are typically purchased with credit, such as homes, automobiles, and probably even furniture and large appliances.
Yeah, so at a high level, inflation and interest rate, they kind of move in the same direction because interest rates are the fundamental tool used by a country's central bank or the Fed in the United States to manage inflation. As the theory goes, if it is more expensive to borrow money or carry a balance on a credit card, consumers will very soon start spending less. When consumers actually start spending less, demand is going to fall. And eventually, when the demand falls, so will be the price of everyday goods.
Yes, however, there's a risk to all this. Economists warn that the combination of high borrowing costs, high inflation, and slower growth could tip the economy into a recession. The fear here is that if the central banks move too fast or too aggressive in raising the interest rates, it could kill the growth machine completely and we would all be in the recession. So the onus is on the central banks to choose its moves very carefully.
Now that we've understood how the macro picture works, let's look at it from a stock market perspective. How did the stock markets actually get to where it is?
That's right, Abby. The pandemic caused a lot of folks to be out of work, and in response to that, the governments across the world pumped money into the system through various stimulus payments and lowered interest rates to keep the growth in the economy going.
Meanwhile, the country began to suffer from a supply chain breakdown, which was spurred by the pandemic and impacted by other factors, including natural disasters.
And just when the things were beginning to bounce back, the war in Ukraine really further complicated things.
So this is how it works. Both Russia and Ukraine, they play a major role in global agriculture. And the inability to import food from either country has impacted availability and prices across the world. This further has aggravated supply chains.
Exactly. We are at a time when there's a lot of money in the economy, which means there's high demand, but the supply is just not there. All these factors have contributed to inflation, which the central banks across the world are trying to combat by raising higher interest rates. And the stock markets across the world are responding very negatively to this news because the fear is that the earnings of the companies are going to go down as a result of the higher interest rates.
So the question here is, why is the news about increased interest rates impacting the stock market? So one point to consider is that the Fed is raising interest rates to take money out of the market. And the impact of this is that it's going to lessen the demand and help manage inflation.
If interest rates are high, people can buy bonds that are issued by the federal government because they want to capitalize on the high yield. So when they buy those bonds, they give money back to the federal government. Now you can understand that this is a way to suck out money from the system, and it helps to reduce the high amount of money that we have in the circulation. Now, where was all this high money in circulation funded from? Well, one source of funds is definitely the stocks we all have, and hence the equities also typically go in oversold category.
However, there is one more problem. Increased interest rates also means that the cost of borrowing money is going up, and investors actually see this as bad news. So when you talk about the rates, all the rates are going up. The mortgage rates are going up, the credit card rates are going up, the car loans are going to go up, even repayment of student loans is going to go up. And all of this collectively is very bad news. And once the market perceives something as bad news, the stock market actually reacts negatively and prices drop.
And the interest rate hikes by central banks across the world suggest that they are taking an aggressive posture to fight inflation. It is expected that this aggressive posture will cool down inflation on the long term. We hope this gives you some perspective into what the market is doing. But you would be wondering, what should the average investor do now?
Stay tuned to Investor Diaries. We are excited to be back to bring you quality research that's going to help you navigate through these tough times. So please, if you've not already done so, please subscribe to Investor Diaries and click on the notification icon next to it so that you don't miss our next video.
And before we sign off, it bears repeating, do not panic and do not stop investing in your 401k or your other retirement plans. We'll speak about our strategies and techniques in our next video, but until next time, stay strong and stay focused.